Good morning, Jeremy.
Morning, Bram.
Jeremy, in our last interview we talked about the importance of the fiduciary care and transparency for the customer and the way you exercise it.
Yeah.
We briefly touched upon costs of the investments made by the investment manager. And I would like to go into that today, because why are costs so important to the client?
Very, very good question, Brian. Well, effectively, the more money we keep, the more we make. The more money we can keep in our pocket, the more capital that we originally have,
Yes,
the more we can keep, then effectively our greater our reward over time.
of course.
I said before, we're long-term investors. We believe that investing is not trading. It is creating wealth over time. And we do need that time. So if I go back, say, 25 years since I've been managing, or 50 years, let's say, the first 25 or 30 years were excellent. Costs were high, but people in the main were getting good returns on their investments, so they were happy to pay the costs. In the last 25 years, what has changed? The competition has become tremendous. We've expanded to a global marketplace. New exchanges have opened up. The transfer of data is now huge. Everybody has access to all the information pretty much at the same time. In fact, the regulator demands that it is given at the same time. And so there are just so many people that are so good at what they're doing, working all day, working all night. The Bloomberg machine, which when I started 25, 30 odd years ago was, I think there were 6 in existence, and the major banks and the brokerage houses had them. Now there are 350,000 in existence. So the sheer weight of competition, the sheer quality of people managing money has got it's such an insightful aspect of investing now, that the idea that you could do better than anybody else really is a myth. 25 years ago, 30 years ago, perhaps you were paying 10 basis points. Now you'll be paying 1% or 1.5% as an active management fee. So the economies of scale, in other words, there's far more money managed today. I read a headline today, for example, that there will be, by 2025, $265 trillion of assets managed worldwide in mutual funds. Today, there's something like $9 trillion. So you'd have thought this economies of scale would have meant people would lower their costs, but in fact, quite the opposite's happened. So the average fee's gone from 10 basis points, say 30 years ago, to almost 1.5% today. And that is a huge drag on the performance of a portfolio, the money that you've already given, because you have the capital to a manager to manage over time, as opposed to accepting the market risk of return, which in fact is indexing, where effectively you may be paying maximum 25 basis points, 25, a quarter of 1%, as opposed to 1.5%. And over the years, that's a huge drag on your overall capital, which you want to grow in an investment.
Okay, so what can be done to reduce those costs for the client?
Well, we ourselves take a view that we need to be keeping the costs to the absolute minimum possible in any investment process. And the first point of that, the first, if you like, stepping stone for that, or building block for that, is the investment mandate, which perhaps we can talk about next time we meet. Okay.
Well, thank you very much, Jeremy, for that explanation about costs, which indeed is very important to every investor. And I look forward to be able to share with you the details of the investment mandate and the process that leads to the investment mandate on the next interview.
Right.
Thank you.